Welcome to this explainer. Look, if you've ever felt like Silicon Valley operates in its own secret language, especially when, your actual money is on the line, you're completely right. Today we're going to crack that code. We're taking the dense, intimidating jargon of seed financing and transforming it into clear, actionable knowledge. By the end of our time together, you're going to have the battle-tested dictionary you need to navigate from your very first investor meeting all the way to having money in the bank. So let me ask you this. Do you know the exact difference between a cap and a discount? If you're a founder raising capital and you even hesitated on that question, well, that hesitation could literally cost you your company. We aren't just memorizing definitions today. We're learning the actual mechanics of survival in the startup world. Okay, let's dive into this. Here is our roadmap for today. First, meet your investors. Second, the instruments. Third, the mechanics. Fourth, the math. And finally, closing the deal. All right, section 1, meet your investors. Who is at the table? Before we can even look at the math or the legal documents, we need to know exactly whose money we're taking, right? Because not all money behaves the same way. The landscape is generally split into two camps, angels and venture capitalists. Angels are essentially amateurs, often wealthy individuals acting very much like hobbyists. They're investing their own money entirely on their own terms. And because of that, their decision-making is usually fast and, honestly, heavily driven by emotion. VCs, on the other hand, are the pros. They're investing other people's money, specifically limited partners funds. Since they answer to someone else, they require a much more rigorous process. You can definitely expect more time, multiple meetings, and a need for consensus among partners. Knowing exactly who is across the table dictates how you pitch them. Moving right along to section 2, the instruments. These are your legal funding vehicles. Once you actually convince an investor to give you money, how does that capital legally transfer to your company? Well, in early seed rounds, it's rarely as straightforward as simply selling equity. For a long time, the standard vehicle was a convertible note. At its core, a convertible note is actually a debt instrument. It's a loan. The investor gives you cash now, and the loan carries an interest rate and a maturity date for when it must be repaid. But here's the catch. The intention isn't for you to actually pay the money back. The intention is that this loan will automatically convert into stock when you raise a larger, priced equity round down the road. The problem is, dealing with interest rates and maturity dates adds a huge amount of legal baggage for a brand new startup. Now, what's really interesting about this slide is how the ecosystem evolved to solve that exact problem. Enter the SAFE, created by Y-Combinator. It stands for Simple Agreement for Future Equity. It acts just like a convertible note, but it entirely removes the interest rates and the repayment requirements. It's a real game changer. It revolutionized early fundraising by stripping away the complexities of traditional debt, leaving you with just a clean agreement that an investor's cash today will buy them shares in the future. That brings us to section 3, the mechanics, pricing the instruments. So if an investor is giving you money today via a SAFE or a note, but they don't actually get their shares until a future equity round, how do we make sure they get a fair deal? Early investors are taking a massive risk, so they absolutely expect a seed premium in return. The primary way they secure this premium is through a cap, sometimes called a target valuation. Think of a cap as a protective ceiling for the investor. Let's say an investor gives you money on a SAFE with a $5 million cap. If your company absolutely explodes in value and your next round is valued at $20 million, well, that early investor's money still converts into shares as if the company was only worth $5 million. It just ensures their early, risky bet buys them a fair, appropriately large slice of the pie later on. The other lever you'll see is a discount. This is exactly what it sounds like. It's a percentage reduction, say 20% off, from the valuation of your future round. It's really just an alternative way to reward an early investor by guaranteeing them a cheaper entry price per share than the new investors coming in later. All right, section 4, the math, calculating dilution. We're reaching the most absolutely crucial part of this explainer. You can know all the vocabulary in the world, but if you don't understand the actual numbers behind these concepts, you will lose your company piece by piece. Before we calculate anything, you have to understand these two terms perfectly. Pre-money valuation is what your company is worth right before the investor's money hits your bank account. Post-money valuation is the value of the company immediately after that investment is added to the bank. It seems like a subtle difference, I know, but as we're about to see, confusing the two is a fatal error when calculating your share price. And that matters purely because of this word, dilution. Dilution is the percentage your ownership share is decreased when new shares get issued to investors. Frame it in your mind as the necessary cost of doing business. You have to give up a piece of your pie to get the ingredients you need to grow the whole bakery. But you need to know exactly how big a piece you're handing over. Let's walk through this 5-step scenario straight from the Y-Combinator guide. Imagine you agreed to raise $1 million on a $5 million pre-money valuation, and you currently have 10 million shares outstanding. Okay, step 1, your share price is based on the pre-money valuation. So $5 million divided by 10 million shares means shares are 50 cents each. Step 2, at 50 cents a share, to raise $1 million, you must sell 2 million new shares to the investor. Step 3, your new total share count is now your original 10 million plus the 2 million new ones, making 12 million shares total. Step 4, your post-money valuation is now $6 million. That's your 5 million pre-money plus the 1 million in cash. And finally, step 5. What is the investor's ownership? Your dilution. It's their 2 million shares divided by the new total of 12 million. When we crunch those numbers, the crucial takeaway is this. The actual investor dilution is 16.7%. And this brilliantly illustrates a common, super dangerous founder misconception. Far too many founders think raising $1 million on a $5 million valuation means giving up 1 divided by 5, or 20% of their company. No way. The investor's ownership is calculated against the post-money total. 1 million is a sixth of the 6 million post-money valuation, not a fifth. The math matters. Let's move to our final section, part 5, closing the deal. Theory meets reality. Now that we've survived the math, let's look at what actually happens at the negotiating table. Legendary investor Paul Graham famously said, "If the soda is empty, stop making that awful sucking sound with the straw." Look, investors have 100 different polite ways to say no without actually saying the word no. The hardest thing for an entrepreneur to learn is when to recognize they're being turned down, accept it, walk away gracefully, and just move on to the next prospect. But when you do get a yes, here are your golden rules for closing. First, get the best deal you can, but prioritize actually getting the deal. Don't over-optimize your valuation at the seed stage, just get the cash you need to build. Second, do not negotiate in real time. Investors do this every single day, you don't. Take their requests, step away, and consult your advisors. Third, use standard trusted documents like YC Safe to avoid expensive legal back and forths. And finally, close rapidly. Once an investor says yes, use a handshake protocol to immediately lock it in and get the signature and the funds before momentum dies. By the way, practically everything we've covered today, from understanding your investors to the specific math of dilution, comes directly from the battle-tested playbooks of Y-Combinator, which is arguably the most successful startup accelerator in history. This isn't just theory, this is literally how deals get done in Silicon Valley. Which leaves us with one final essential thought. Now that you know the mechanics, the instruments, and the math, what is your company actually worth? Well, there's no magic formula. Ultimately, your startup is worth exactly what you can convince an investor it's worth. Your job now is to go out there and build something that makes your valuation absolutely undeniable. Keep learning, keep building, and I'll see you in the next explainer.